One of the most important parts in analyzing a deal is calculating the post-renovation market rents. So these are the rents that you can get after you do some sort of value add project. And if you get these numbers off, it can really make the analysis skewed one way or another, either make a bad deal look good or make a good deal look bad. So it's key to get these things right. So let's dig in and I'll show you how to get these post renovation market rents correct to make sure that you're analyzing the deal correctly. So post renovation market rent impact. I said it's very important. Here's an example of some numbers for a post renovation. You get your current rents there, your projected, and then I put in a number for what they actually came in at. So in this example, the person did their projected rents for their analysis. For one bedrooms, they had $700 a month. Two bedrooms, $950 a month. Three bedrooms, $1,000 a month. And they overstated them in this example by $100 a month per unit type. So if you look down here, I have the gross income, potential income that you can get from just those rents annualized. I put an estimated expense number in and just kept that the same just so it doesn't mess anything up. And then the net operating income, which is the income minus all the expenses. So you can see the difference here for just a 7 cap property. So this is a property that's viewed at a 7 cap rate. You're looking at currently with the rents that are in place for this 8-unit property, it values at $400,000 at a 7 cap. You projected doing your analysis, which came out to $47,800 in net operating income, and that would have been put you at a price when you're doing your analysis at $682,000, almost $683,000 for the value. Now, if you just miss the rents for each unit by $100, you change that price when you're exiting, whether you're refinancing, selling, whatever it is. You would change that down to $545,000. So that's a difference of $137,000 in your exit projection, which can drastically change, your returns, whether it's a good deal, whether it's a bad deal. And this is only for an 8-unit example. You mess up on an even bigger scale, and you're looking at an even bigger difference there. So when you're looking at post renovation market rent impact, it's going to impact cash flow. If you get those numbers wrong and they're too low, you're not going to have the cash flow that you project. When you go to refinance or sell the property, you're going to have problems because if you budgeted it too or projected it too high, you're not going to get the value that you want when you refinance. So you're not going to get the money back that you want. It might not make sense to refinance, and then if you sell it, you're not going to get the returns for you or the investor if you're doing a bigger property. So it can really drastically impact how a property looks, and it can make you buy, if you overestimate, it can make you buy a property that you shouldn't buy, and then kind of get yourself in some hot water there. So when you're doing the market rent research for when what you project them to be post renovation, you got to do a couple things. You got to identify comparable properties. So this is properties that have the same amenities that you're going to go for, same size and layout as the property that you're looking at, same kind of finishes that you'll be looking for. That all makes sense. You want to compare apartments that you're doing or what they're going to be when you're done to other ones in the area to get the best idea of what that's going to be. So you can gather data on different avenues. You can do stuff like apartments.com or rent.com where they have listings. So you can gather that data there. They'll give you pictures of what the units look like for apartment complexes, give you rent amounts. Rentometer.com can give you some simple numbers of average, medians, standard deviation of rents, what the high ones are going for in the unit or in the area, what the low ones are going for, and then even have some rental listings. So that's a good tool to use. Property managers, they have boots on the ground, latest data for you, so they can really advise you. So if you have a couple good property managers that you can consult, that's great. They can even pull data for you of recent listings, recent sales, that kind of stuff. So that's some great. There's other ways to get it, but those are a couple of the great ones. And you got to also keep in mind any sort of market trends. So that data might be there at the moment, this is what you might, let's say you project out after everything, $1,200 a month for some unit. If the area is appreciating, getting nicer, those rents might not be 1,200, they might be 1,300 by the time you're done the renovation. Or if the market's trending the other way, they could be, $100 less a month by the time you're done renovation. So you kind of need to know where the market's going. I included some here. We were looking at a property up in Harrisburg. It was actually in Paxtang Borough. So if you look at the bottom there, there's 2020 median household income. And this is just a small borough within that same area of Harrisburg, PA. And look at the drastic difference in incomes, medium incomes, household income there. So if you're not getting other ones in Paxtang or close enough to that property, you might be underestimating what rents you could get because there's a vast difference in incomes depending on where you are in that area. And then just some other data on vacancy. If the vacancy is super low, so most properties are at 97, 98%. That means there's not enough supply or there's still demand in that area for apartments. So you want to look at all that kind of stuff. This is just some stuff that we looked at when we were looking at the Harrisburg property and stuff that you'd be wanting to look at when you're doing your market analysis and then doing, the market rent research. So then once you do your rental comp, what you want to do is put it all together kind of like this here. So this was for that Harrisburg property that we looked at. I pulled all the 2 bedrooms, all the 1 bedrooms that were the closest in area, same kind of market, same kind of area. And then you can do this more advanced and kind of break it down by what specific amenities they offer. But you want to get a rent per square foot because it could be a 1 bedroom, but it could be 650 square feet, like in this example, or 913 square feet. So they're vastly going to rent differently. And you want to kind of rate them on, what sort of amenities they have compared to what you're going to do, and then just take the best ones of that to kind of get you an average dollar per square foot of rent, and then that can help you in your analysis. So you want to kind of just compile this data, lay it all out there, and then kind of get the best averages of the properties that they're in the best area, closest to you, most like the units that you're going to renovate. So then you can get a really accurate number for what your units will rent for. And then the other thing that you're going to have to look for is a scope of renovation. So supply and demand for that renovation. If you're going really high end, is there demand in that area? And what's the supply look like for the high end rentals in the area? If there's already oversupply of really high end, it might not make sense to go there because there's not going to be a need for it. So you're going to put these really nice units in and then have to rent them lower than you should because there's not a high end tenant base that needs that unit. So you're going to get lower tenants to fill the property and not get that the highest post market rent that you could. So you're going to look at like the level renovations. And then you're also going to look at the cost of the renovations that you're going to do. So best return on renovation cost. And like I said before, if you're doing in that process, if you're doing renovations for $10,000 a unit, maybe that gets you $100 more in rent. Does it make sense to put $20,000 in a unit, maybe get $250 more in rent? Those are the kind of things that you got to weigh out and see what you're getting on the return on your money that you're putting in. Some value adds might not work because you're going to be putting a bunch of money in and you're not going to get any, significant amount of increased rent there when you're done the renovation. So that's one thing you got to look at. And then just what market specific amenities do people want in this area? What are common? What are people kind of looking for? That can vary by area. So just know your area well. Know which ones do they want washers and dryers? Do people not really care about washers and dryers? That kind of stuff. You got to know that. So you're not putting stuff in your units that's not going to add any value to the property because the tenant base doesn't really want it. So determining your market rent and business plan, you compile those numbers, found the rents, but you also got to find the best scenario, best business plan that works for you and gives you the best return. So you want to run multiple scenarios, like I said, maybe doing low to medium renovations, doing high renovations. What's that rent look like? Um, what renovation package gives you the best bang for your buck, and also what has the lowest, or highest risk return for doing those renovations. So, what has a lot of supply or has a lot of demand for that type of unit, and isn't going to, break the bank in doing that. So you got to take that into account if you're kind of putting in something that's new to the market and you don't have any sort of data to back up whether that's going to work or not. You're going to have a lot of risk there, and you might not get the returns that you need. So you got to weigh that. Um, and then what you want to do is you want to verify that your calculations are correct. So you want to consult with, if you're doing the renovation scope, you want to consult with multiple contractors, make sure, you're laying out a plan, make sure you're nailing down the cost of everything, and that cost pretty specifically going into it. And then as far as just the post-reno rents that you're calculating, agents, property management, other investors in the area, if you have that contact, just run your numbers by them. Make sure that they agree with your numbers and that they make sense for the area based on their data. And then just make any adjustments if need be. If a different business plan than what you originally went into makes the most sense as far as returns, as far as lowering your risk, then you might want to go with that. But that's basically how you want to determine the post renovation market rent, and it's a key factor. So make sure you're doing this correctly and accurately.